Airline pilots, a big change coming at you for your 401k contribution limits and your retirement plans, regardless of what airline you're working for. So as we look ahead towards 2026 and the arrival of the new Secure Act 2.0 and some of the changes that are going to be implemented that will affect how you will plan for your retirement and your overall investment strategy. We have all that for you and more, so let's go ahead and get started.
Hello and welcome to the Pilot Money Podcast. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies and ARS Private Wealth. Together, we give you the tools and advice you need to take advantage of the ever-changing financial world and help you take care of the business end of your professional aviation career. As financial fiduciaries, we bring you up-to-date, relevant, and independent information so that you can make sound financial decisions for yourself, your family, and your eventual retirement from the airlines. Don't forget to hit the subscribe button so that you can stay up to date on any timely information that we bring to the professional aviation community. Or you can also visit us online at www.pilotmoney.com. Once again, welcome to the Pilot Money Podcast.
As an airline pilot, if you want to achieve financial success, it's absolutely crucial that you remember that your career is not the same as the average person out there that doesn't fly for an airline. The benefits that we're enjoying today as airline pilots are absolutely off the scale. Defined contribution rates at 18%. Pretty much almost every financial benefit in these contracts is represented that the pilots can take advantage of, but more importantly, the pay is more than it ever has been in history for airline pilots, meaning that we have the financial resources to take advantage of all these amazing benefits. But what's important to remember is that as pilots, we have a lot in common. We like the same things. We almost kind of have the same lifestyle. But as soon as we step out of the cockpit, our financial lives are literally as unique as a fingerprint. And it's important to treat it that way, to take all of these benefits and somehow arrange them like a puzzle so that they actually work for you specifically with whatever it is that you're trying to do for the short term, the medium term, or the long term. And also keep in mind that as a pilot, your career is finite. So you have a limited amount of time to take advantage of all these amazing benefits. Regardless of what stage you are in your career, it's important when you do financial planning, when you plan for your benefits, you have to look at it from the short term, the medium term, and also the long term, especially if you are nearing the end of your career, nearing the mandatory retirement age. Financial planning is a complex problem. There's a lot of moving parts, there's a lot of unknowns, there's a lot of variables. So it's important to take a big problem and break it down into smaller pieces so that those smaller pieces then become easier to solve for. You solve enough smaller pieces and eventually you solve the bigger picture. Well, when it comes to benefit planning, it's really no different. Because of the finite nature of a pilot's career, it's important to keep in mind the three phases that you go through in your financial life. By breaking down your financial life into phases, it helps you plan for them independently, all the while making sure that they're all still working together as a whole towards making your goals happen for whatever phase that you're on in your career, but more importantly, retirement as you enter a distribution phase where you have to systematically start taking assets out of your portfolios to be able to live off of them. Breaking down your financial life into smaller segments is absolutely crucial for the long-term planning as a mandatory retirement age looms out there in the future. If you think about it, your financial phase, your first phase that you're ever going to go into is your accumulation phase. Your accumulation phase started when you first started working, first started savings, and this is probably going to go on well into retirement as well, because we have to always grow your wealth, not only for longevity, but also for legacy planning, if that's important to you. So, but when you retire, if you're an airline pilot, and this happens from one day to the next, is you're going to enter the next phase, which is called distribution. And distribution is where you receive distributions from your assets while dynamically adapting to a constantly changing environment. What makes distribution a little bit more challenging is the fact that we can't stop accumulation while we're distributing. We have to continue growing your assets well into retirement to keep up with inflation, taxes, and all those kinds of things. So we have to continue growing your portfolio all the while you're fighting it every step of the way, because you're constantly taking money out of their portfolio so that you can pay your bills and do all the things that you need to do. But if you do all of those correctly, then finally you're going to end up in the transfer phase, which is basically estate planning, and it ensures a pilot's assets transfers according to his or her wishes. You have to remember that your assets are going to transfer one way or another. You might as well make sure that they transfer according to your wishes. And as a pilot, if you think about your financial life, there will never be a time where you're not preparing, or at least in one of these phases on a congruent basis where they're all working together at all times. But if you break them down this way, they're a little bit easier to plan for. Before we get into the contribution limit changes for 2026, there are some changes and there's pretty significant, but it's important to keep in mind from a planning standpoint that the contribution limits, it's not just about that. It's not whether you're going to do Roth contributions or pre-tax contributions, whatever it may be. You have to keep everything in mind because the benefits at your airline, at any airline, especially the major airlines, they're so complex and they're so sophisticated. You have market-based cash balance plans, you have retiree health account, you have after-tax compensation if you want it. You have vacation forfeitures. You have all these complicated things that are constantly in the mix. And it's important to plan for all of these independently for yourself and not really so much worry about what other people are doing, planning for yourself and in a unique fashion so that you can adapt all of these phenomenal benefits that you have and make them unique to your specific financial life. So let's go ahead and get into the contribution limits. So for 2026, there's some significant changes to how you can contribute to your retirement plans, especially your 401k and the catch-up contributions. So the Secure Act 2.0, which is still going to be in place. This is something that was passed in 2022, but it's going to affect how you contribute to your plans in 2026 as well. So starting in January 1 of 2026, employees that are age 50 or older who earn more than $150,000 in 2025, basically this year, all the catch-up contributions that you make, they have to be on an after-tax Roth basis. This is a significant difference where before you could elect to make your contributions either on a Roth basis or a pre-tax basis, but if you're making $150,000 or more, starting next year, you can only make them on a after-tax Roth basis. And also in the 2026, the Roth catch-up rule, it does not apply to traditional IRA contributions. So if you're contributing to a traditional IRA, or if you're a spousal IRA, or you do a Roth IRA, whatever it may be, these limits do not apply to traditional IRAs. Obviously, if you're doing a Roth, it really doesn't matter. It's the same thing. But if traditional IRA, you can do either pre-tax or you can do after tax. And here basically are the limits for 2026. So the limits this year or next year is going to be $24,500. That's a $1,000 jump from last year in 2025. And if you're age 50 or older, you can make a catch-up contribution of $8,000. And remember, this catch-up contribution has to be on a Roth basis. The IRA limits are $7,000, and also the catch-up contribution is $1,100. That's kind of a weird number. Normally, last year would have been 1,000, but now they're going to start adjusting for inflation, and the catch-up contributions are going to be, it's a little bit stranger numbers than before, like 1,100, 1,200, 1,300, depending on what the inflation rate is. But for 2026, it's going to be $1,100. And also the 415 limit, which is the overall limit for your 401k contributions plus the company contributions through defined contribution plans that they have, is going to be $72,000. And if you can do catch-up contributions inside of your 401k, that's an additional $8,000. So the totals for the catch-ups are, if you are, it's $24,500 if you're age 50 or lower, but if you're age 50 or above, you can do the additional $8,000 for a total of $32,500. Also for the IRA, you can do a total of $8,100 if you're age 50 or over, $7,000 of course if you're less than 50. And then the the 415 limits, sorry, not IRA, the 415 limits for the overall limits for the planned contributions and your contributions is $72,000. And if you elect to do catch-ups at $8,000, giving you a total of $80,000 that you can put into these plans. Now, any contributions that are done by the company in the defined contribution plans, these, depending on the airline that you're in, will either go to the market-based cash balance plan if you've made that election. They're either going to be paid out to you in cash, or they're going to be going to a retiree health account. Again, it all depends on the airline that you're working for, because every airline has its own nuances in how they treat excess money beyond these limits. So there is also something called a super catch-up, which is also in place in 2025. If you fall into the category of 60, 61, 62, and 63, you can do an additional $11,250 of catch-up that replaces the $8,000 catch-up. So instead of making $8,000, if you fall into these 8 groups, you can make an additional $11,250, bringing your total 401k contribution limit, including catch-up, to $35,750. This is a significant jump from anybody not in that age group. So if you are in this age group, it's definitely worthwhile taking advantage of. 415 limit, which is going to be 83,250 if you are that age range, because you can do the 72,000 plus the 11,250, give you a total of 83,250 total into your plans. For the 415 limit is not applicable to company contributions because they do not make catch-up contributions for you. You do that on your own. So why is it important to understand these limits and how they apply to you specifically at whatever airline it is that you're working for? Well, if you think about it, these limits in itself, they're not very complicated. They're pretty easy to understand. But because the pilots are making so much money and the defined contribution plan where the company's making 18% contributions based on your salary up to $360,000, it's a significant benefit to have. And what happens is, because you're making so much money, you're going to go beyond these limits and making sure that you plan as to what you want to do with that money, whether you want to pay it out to you, whether you want to go to a retiree health account, or whatever it is that you're doing based on the airline that you're working at. It's important to plan for these limits accordingly, because they can have a significant impact on how much taxes you pay, also significant income on how you potentially pay taxes in retirement. There's a lot to it, and all these pieces of the puzzle, they're all working together, and they're all related somehow. If you pull one lever on one end, something else is going to be affected down the line. And it's important to understand these relationships. So as you go through the planning stage for 2026 and how to make these contributions, please give us a call and we can happy to help you through the process, because it's important, because taxation at the levels that you're making money is a significant problem to have if you do it incorrectly, and you could potentially lose some money if you're not careful about how to go about it. And it's pretty easy to avoid, at least make an efficient and effective tax plan for yourself, whether you're working today or going into retirement, whatever phase that you happen to be in, accumulation, distribution, or transfer phase. It's important to plan for all these. We're happy to help you out. In the meantime, if you have any questions, give us a call. And thanks for listening, and we'll be talking to you soon.